joins us, represents SageOne Investment Advisors. Good to have you back.
Hi, good morning, Nico. Always a pleasure to be here.
What is your current market view? Do you think this market will sustain this kind of an extraordinary run-up from June 4th when we had a panic low? The market has erased off all the gains. A lot of popular stocks are way above what their levels were from even on 3rd of June.
Yes, I think it's very difficult to look at market as one because there is such a huge divergence that has happened across different segments in the market. For example, if you look at companies which are more focused towards government business, some of them have run up 8-10 times over the last 2.5-3 years. And if you look at the valuations for them, it's probably 6x or 7x what they used to trade at 2.5 years back. Now, question is, how much of sort of the hype or the order book is going to be really realized, at the right profitability and, receiving the right cash flow at the right time. It's a big question. And a lot of these companies, for example, railways, and some of these defense companies, in the past, if you see last 15 years, they've at least gone through 80 to 90% kind of a correction 3 times. So that's a possibility. It's not sort of an exception, but every 5 years or every cycle, and after the cycle ends, a lot of these companies do go through a huge correction. I'm sure there will be few winners, but those will be extremely handful. But the entire segment going up, I'm not sure if most of them are going to be anywhere close to these kind of valuations when the correction comes in. And 80-90% correction is a huge correction. I mean, jumping from 90% correction is like 10x returns that you need to generate to just recover the kind of losses, right? So overall, I think if you stick with the right segment, because there are many segments on the private side which haven't done much over the last 1.5-2 years, and their valuations are pretty reasonable. They will also benefit from India doing well, but where there is not much of hype. So overall, I am really constructive on the market. I believe that if you look at the 2003 to 2008 cycle, the corporate India, the BSE 500 growth was 32% per year, right? And the small caps and mid caps were closer to 40% per year. Maybe we may not go to that kind of a growth, but I'm pretty sure that we can have at least half of that growth over the next 4 to 5 years. And if you are a good stock picker, if you are able to find at least 5-7% extra earnings growth, which is closer to 25% earnings growth, even if they may be 20-25% overvalued, but over a 4 to 5 year kind of a period, I think you can make a lot of money. So I am extremely constructive on that part of the market. It is going to be a stock pickers kind of a market, and there are a lot of opportunities. But if you know what not to invest in, half of your job will be done. Then out of the remaining, if you pick reasonably good stocks, you can generate a lot of alpha against the market.
Okay. When you say what not to invest in, how does that list look like? And what does that list contain?
So a lot of businesses which are, catering to the government as a customer, capital goods where there is quite a lot of hype. I mean, a lot of these businesses which have never really traded at, 70, 80, 90 times kind of a multiple are trading at that kind of multiples. And see, I am always careful on businesses which are capex oriented, because capex is an extremely uncertain event, and a lot of times you may have great capex years for 3-4 years, but even if you get one bad year, at that time, because of the hype, many of these companies will have expanded their capacity so much that even if you get 1 or 2 bad years where their capacity utilization is below par, 50-40%, they can go into losses. And when such things happen, that's where you get that kind of a correction of 80-90%. So the ride is fun, but then you need to know that it can go through a sharp free fall And if you enjoy the free falls, I think you can ride those, but you need to be careful, in such companies. So valuation, if it's a consumable where you know that every year the growth is going to come through, it's not just dependent on one customer. There you can take a little bit of risk, even if the valuation is 20, 30, 40% higher than what you are comfortable with. Maybe you will lose out on 1.5 years of earnings growth. But if your holding period is 4 to 5 years, at least you will not lose much money. In the short run, maybe you will see a reasonable fall. But over a 4 to 5 year period, you can still make above average or above market kind of returns.
When you say you don't like government businesses, are you ignoring the fact that there is a serious tailwind there? Government is spending, the capex cycle is still strong, and typically these cycles they last for multiple years. So are you ignoring the good thing that is happening in the sector?
No, see, these are, I mean, these can give you multi-bag returns, in the short run, right? But the entry point is extremely important in these businesses because they tend to be very, very cyclical, right? So if you enter into these businesses when the margins are at all-time high and the P multiples are at all-time high, I think, it's extremely risky, because when the margins contract, and if you see the history, the margins are hugely variable. No one can really predict their margins, right? Sometimes they can have negative margins, 2% margin. Some of these companies are trading at are getting 12% margin, and over and above that, you're applying 6x, 7x higher multiple than what they used to get 2.5 years back, right? So the entry point is extremely important. So if you are getting in when the margins are low, the P multiples are low, that's great. Smart investors would be doing that, right? And if you really ask even the smartest of investors, someone who got into these stocks maybe 2.5 years back when the multiples were low, I don't think they will be still holding them when the multiples are 6, 7, 8 times higher than what they used to be, right? So a lot of times, money is made by getting into stocks where you are confident of holding them for a very long period of time. Many a times such cyclical sectors is all about timing. And, even the smartest of investors cannot ride the entire bull market in such companies. And especially if you're too late in this, you need to be extremely careful. So that's what I'm saying. I'm not saying don't invest in it, but there are times when you can take risk. High risk, high return pays a lot in such sectors, especially when the goings are really bad for them, and then you are sort of coming into a really good cycle. But when you're already excited about them, when you're almost at the peak of the excitement, it's one of the most dangerous times to get into such stocks.
That's the problem, Samit. Hi, this is Anisha also joining in the conversation. For a lot of
Hi,
sectors,
Anisha.
we are at the peak of optimism, right? They're baking in the best in terms of order inflows, etc. A couple of places where there's still sort of a lack of belief or a bit of disbelief are those like IT, FMCG, chemicals, etc. Are you saying that perhaps it's time to bet on the underperformers?
I'm not saying that. I mean, see, for some, maybe that maybe those may be the sectors. But see, I am looking at companies where I'm expecting close to 25% kind of earnings growth. A lot of companies in the IT sector or FMCG will never give you that, even half of that. So they are never really part of my portfolio. Um, uh, Specialty chemical is a very different ball game. I mean, it's been struggling, and there are intermittent signs of it reviving, but still, it's very difficult. China's dumping and the competition across the globe. When a lot of chemical companies went through huge capacity expansion, and then it is impacting the margins significantly. And so, maybe it's not the right time yet, but there will be time. But, similar, if you see the capacity expansion happening across many of these companies, I mean, just look at the number of QIPs which are coming, and they will go through similar fate what chemical companies went through before. So one needs to be careful on that. So even if it's not IT or FMCG or chemicals, I think even within building material, which are catering more towards the private kind of a capex, some things like which are into niche building materials. I think they haven't done really well over the last 1.5 years, and there the valuations are pretty reasonable. I'm pretty sure if not, if India does well, they may not grow during the capex times, but they will grow at with a lag. And in the long run, over a 5 to 6 year period, though their growth can be even better than a lot of these capex oriented companies, but also with a lot of confidence. There is the reliability of the earnings growth is high. The margins variation is very low. So they don't go through these 80-90% kind of a fall. They may go through 20-30% kind of a fall, which is something that you should always be ready, because that's sometimes 1 year kind of returns, and 1 year returns can be made up with then the next year kind of a return. But if you are into companies which can fall 80-90%, sometimes it can take your entire life to recover that kind of money.
So that's a take coming in. So you have to be very, very selective and look for those high growth areas. But Samit, if somebody had to make fresh investments right now, would you tell them to perhaps make investments to play the urban consumption theme, or is it about rural recovery which is going to play out better?
See, I think things which are doing already well are more to do with the spending by the government, by the private. Government has already been spending over the last 2.5 years. Slowly, private companies are also, coming up with the capex, right? So, I think follow the earnings. Where you are seeing the earnings are more in real estate, in building materials, which are catering to a lot of these themes. So whether government does capex or private players does capex, they do get benefited. They may not have the same kind of an order book as what a lot of these capex oriented players do, but they will consistently grow at 20-25% for a prolonged period of time. So there the chance of losing money is low. So I would say currently stick with that. Maybe I never like to preempt, if rural is going to do well or, urban is going to do well. We can take a call once the, that growth starts, because once the growth starts, it's not going to last for just few months. It may last for sometimes, years. And, late into that by a couple of quarters, it's not going to harm you that much. So I would always let the earnings start coming through and then follow the earnings.
Samit, hi, morning. Curious to actually understand what you make of all that's happening when it comes to quick commerce. A lot of analysts and experts are talking about how the unit economics will only continue. There's going to be an expanded user base. I know all of us in the studio are pretty addicted to some of these apps as well. So where is it that you stand when it comes to the entire space, and in particular, maybe some of these quick commerce players?
Yeah, I mean, this space is always tricky. We have really, we have analyzed these segments really deeply. A couple of, my team members are really, good at analyzing these companies. But so we do have, one of those two plays in our large cap space, which I don't manage. But for me, I'm a really old style conventional investor. I need high profitability, high return on equity, high return on capital. Reasonable growth is fine. I'm not looking for 50% kind of growth. If I get that, great. But still, I need ROE, ROCE. So I would stick with that. Minimum ROE, ROC of 20%, growth closer to 25%, reasonable valuation where 1 year at a portfolio level, 1 year forward multiple is closer to the growth rate. If I get that, I'm more happy with that rather than betting on something which is futuristic where I don't know how and where they will settle at. So not really my style of investing.
Style of investing would perhaps be the banking sector, and it's been tumultuous to say the least within this space. That very preferred space of private sector banks didn't quite perform up to the mark. How have you read into all that's happened within banks, especially in light of the fact that even PSUs sort of were at the forefront, and what's the road ahead, more importantly?
Right. Majority of the time I've stayed away from banking segment mainly because of the earnings growth not really meeting my expectation of, closer to 25%. But I do, track it very well, so historically, if you see that 2011, 2019 period was a period when PSUs were in really, really bad shape. They had huge gross NPAs and then they had to write off their book and they were not in a position to lend because their balance sheet didn't allow. So it was sort of a vacuum period where, private banks took away huge market share from them. Right. But after 2019 cleanup, a lot of these PSUs have recapitalized. They are in pretty strong shape now, and they are back in the game. So it's very difficult now for private players to take away market share from them. And so if you look at the growth of private players during that phase, it was way better than the overall market. I think they will struggle to do that. And hence, you've seen that they have gone through a huge time correction because I think their valuations went up and now they're correcting. So probably they have reached reasonable value level, but I don't think they can grow at the same rate at what they had grown at during that phase. When the PSUs really go through uh, huge gross NPA buildup and they peak the cycle where now that their bad assets will really hurt their growth. That's when private banks would do well. So currently, I'm not that excited about the private players just because of the earnings growth. I don't see them. Maybe you can have them outperforming because valuations which have corrected a lot may sort of re-rate or revert to mean. But I'm not looking for such kind of investments. I'm looking more from earnings growth. So hence they don't really qualify in what I look for.
Indian markets have clearly been propelled by the domestic flows, and foreign inflows have continued to remain, foreign investors have remained net sellers. What's your outlook on our dependence on FII flows, and how are you looking at the liquidity situation?
Right. I mean, see, it's always good to have FIs at the lowest level of ownership. At the peak, we had 24% of market owned by FIs. Today, we are close to 16%. So, most of the remainder of investors probably are going to be long term. So, highly unlikely that they will keep on selling more where this ownership is going to go lower. So, I think probably we are at the bottom of that FII selling cycle. And it's more likely that we may see ownership going up. I don't think the domestic inflow is going to take a big hit. That's going to stay because the kind of spread that the kind of interest that has been generated across the nation is something it's very difficult to take it back. Unless the market goes through a huge correction and then a lot of investors lose money, that's when such interest goes away. But if the markets continue this kind of a run, and even if it corrects by, and it has done this kind of correction of 10% or 15%, people are okay with that. A lot of the retail investors are extremely smart, pretty well read. They are doing SIPs, they are not trying to time the market as much, and that's generally a much better way of and more sustainable way of investing into the market. And such investors generally can take some volatility. There is very little leverage in the system. I mean, there is FNO kind of a thing, but I don't think that's going to affect the market that much. So I think going forward, FII flow probably will be positive, as well as domestic flow will continue. And hence, the probability of corrections in the market, of large correction in the market, is not that high. At every correction, there is, a lot of there are a lot of investors who are waiting. I mean, I do interact with a lot of family offices or, large investors, and many of them are not fully allocated. They are sitting on a lot of liquidity. They did a lot of redemptions over the last 1 year or 1.5 years because they always thought that the markets were expensive, and many could not come back into the market. So that kind of money is also sitting on the sideline, and that is also ready to come if there is a reasonable correction of 10-15%.
Enough. So, Samit, just to wrap up the conversation, does that mean that you're expecting that perhaps index could give you a maybe low teen kind of return, but individual names, and there are enough of it in the mid cap and small cap universe that can easily give you a 20, 30, 40% kind of returns in a year?
Right. I think index is, valued at average of the last 10 years, and I believe the index can grow close to 15% or even higher than 15%. So you can get mid-teens kind of returns from the index. Problem with the mid and small cap is that there is such a huge variety in those that if you look at the last 1 year, there are segments like PSUs or defense or capex oriented, which have gone up by almost 130, 140%. And there are many, in those pockets which haven't delivered even 35% kind of a growth. So there is a 3 to 4x returns difference in the mid and small cap space. And I believe that if the index grows at 15%, mid and small cap probably will deliver 5 to 7% higher earnings growth. And if you are picking the right pockets where the valuations are reasonable, you can get alpha of 5 to 7%. And that's, you need to be doing much in-depth work. You need to know what you should not invest in. Once you sort of have your right universe and do the right stock picking, there are huge opportunities in this segment where there are many companies which are, doubling their earnings every 3 years. So you are getting a lot of such companies. And even if you pay a little higher valuation, you can make significant alpha in these kind of companies.
Samit, appreciate your time. So glad you could join us. Umesh Shivankar joins us, Executive Vice President and Chairman with Shriram Finance.
If you like this video, then like, share and subscribe to ET Now.